Volume may be light this summer, but there are two stocks that look ready for a short squeeze right now. Before we get into the two names, let's take a second to explain what a short squeeze actually is. For those new to investing, having a basic understanding of this market dynamic can be very helpful. A short squeeze is a stock that has a high short interest ratio. Short interest is generated by short selling. When traders sell shares they don't actually own because they believe the stock is overvalued or faces headwinds likely to push the price down. They borrow the shares from an existing shareholder through their trading platform and sell them into the market at the current higher price, aiming to buy them back later at a lower price. If that works, they make money on the difference. A short squeeze happens when a heavily shorted stock gets a catalyst that causes a lot of buying. That trigger could be something as simple as better than expected earnings or some sort of corporate turnaround that gives investors a reason to put money into the stock. When buying gets hot, short sellers start to cover their positions, betting on the share price going even higher. And if the catalyst is strong enough, you get a massive influx of new investment capital and you get a wave of short covering all at the same time. That combo can quickly absorb all the shares outstanding and send the stock soaring. Those price surges can be 10%, 15%, or even 100% sometimes, depending on the stock and the overall market. All of that includes metrics such as how shorted the stock is, the days to cover, the number of trading days it would take based on the average volume to buy back all the shorted shares, and the strength of the catalyst attracting retail investors to the market. With that in mind, let's take a look at two stocks that appear to be setting up for a short squeeze. The first is Wendy's. Wendy's already had the first part of its short squeeze. It has become something of a meme stock and a favorite among traders on Wall Street bets. The stock has seen some pretty big double-digit gains over the last couple weeks, but I still think this one is in play. Short interest remains high, and the chart action indicates the stock has been repositioning at this slightly higher level. Even after the recent move, it is still trading well below its level a year or two ago. Looks like a short squeeze setup to me that is building into a much bigger opportunity because there are also some bullish catalysts that could bring in more investment later in the year. It has been a very educative volume. This volume could be a support for the stock, and the market is getting more interested. Legitimate buying is matching the shares that short sellers have sold short. Now, it appears more shares are being bought out than sold short. That tells me a base of support is being built. I don't think it's a bad time to get into Wendy's. Yes, it has popped back a little off the lows, but downside risk looks limited given the upside potential. Wendy's could effortlessly rejoin the mainstream of fast food stocks and become a hot name in the industry again. Next is AST SpaceMobile. This one is really two stories in one. On the other hand, short sellers are concerned with short-term issues. It is a startup with new technology, a high cash burn, and a risk of dilution. That's the kind of stuff that naturally makes a pretty compelling case for short sellers, and you can see that reflected in the stock price. It can certainly go lower and is well off its highs. The long-term story is the other side of the coin. That's the bullish trigger, I think. There are also some near-term catalysts that can help get the market excited again and bring buyers back into the stock. There's a lot of volatility, but the overall trend is still up. The company is still a cash-burning startup as it builds out its satellite constellation and definitely faces execution risk. The risk was demonstrated when the Bluebird 7 satellite was lost and the stock sold off after the incident. The long-term perspective is, however, an important counterbalance. The company is viewed as an essential part of the future of 5G, a critical bridge from ground to space. It has agreements with 40 mobile carriers. It has no desire to become a mobile carrier in its own right. Its business model is to provide infrastructure and services to those carriers. This means that one day, almost every 5G customer in the world could be an indirect customer, as their current mobile carriers would be leveraging AST SpaceMobile's infrastructure to provide 5G cellular service. The company has good capital, strong institutional support, and seems to have a pretty clear path to generating meaningful revenue. The loss of the Bluebird 7 satellite created a setback in execution risk, but the next launches should feature even more advanced technology. The Bluebird 10, 11, and 12 satellites are expected to provide data transmission speeds up to twice the rate. So the loss of one satellite is a short-term setback, but the long-term story continues to gain momentum. It's really about getting those satellites in space and turning those existing carrier contracts into revenue at this point. Thanks for watching. Please subscribe to this channel. It helps us a lot.